Welcome back to the deep dive. If you've been tuning in, you'll know we've already spent some time on Harrison's Holdings Berhad. First, we tackled that 5.1 share split, explaining what that really meant.
Yes, and then we dug into their Q3 2024 results, trying to get behind the headline figures.
Exactly. So today we're picking up the trail. We've got the Q4 and the full year 2024 performance reports in front of us. And our mission really is to build on what we already know, see how HHMB finished the year, and maybe get a sense of what's next for them.
Precisely. We laid some good groundwork in those previous deep dives, so now we can use that context to really understand the weight of these latest numbers.
Whether you're an investor keeping tabs, someone tracking the Malaysian FMCG scene, or just curious about this kind of diversified company.
Yeah, we'll try to pull out the key takeaways without drowning you in jargon.
Okay, let's unpack this then. Looking at the full year, 2024, Harrison's Holdings saw revenue dip by, around 3.7%? That's about RM 83.3 million less than 2023.
That's right. And it looks like the main driver there was lower sales in their big, fast-moving consumer products, FMCG division.
In the profit picture, I imagine that followed suit.
It certainly did, and actually the impact was more pronounced there. Their profit before tax, or PBT, took a pretty substantial hit, down nearly 33%. Which is RM 29.5 million.
Wow, okay.
And profit after tax, PBT, and the profit that actually belongs to the shareholders both dropped by over 36%.
So when we talk earnings per share, adjusted for that split we covered.
Right. Adjusting for the 5-for-1 split, the EPS for 2024 comes out at 12.58 cents. Compare that to the adjusted 19.68 cents for 2023. So, yeah, a noticeable decline.
That's a fairly steep slide in profitability. What were the main reasons behind that big PBT drop? Sounds like it was more than just sales volume.
Oh, definitely. The report highlights, several factors working together. There was generally weaker consumer sentiment in Malaysia, people being more cautious with spending.
Okay, that makes sense.
Then there was increased pressure from parallel imports, those cheaper unofficial imports, and also, interestingly, new competitors popping up, specifically in East Malaysia, which is a key area for HHMB.
Right. East Malaysia is significant for them.
On top of that, their gross profit margin shrank. Administrative costs went up. Part of that increase was a provision for doubtful debts, suggesting maybe some issues collecting payments.
Okay.
And finally, higher interest costs due to more borrowing and just higher rates generally. That squeezed the bottom line too. So, yeah, a combination of pressures.
Let's zoom in a bit on the final quarter, Q4 2024. How did that specific period play out?
Well, the trend continued in Q4. Revenue was down again, about 5.4% compared to Q4 of 2023. And again, it was mainly due to lower sales from their main FMCG agencies.
And they mentioned Q4 is usually seasonally lower than Q3, right?
Exactly. The report notes that seasonal dip, which is pretty standard in retail and distribution.
So a seasonal factor, but what about Q4 profit specifically compared to the year before?
The Q4 profit before tax saw a really sharp decrease, down over 45% compared to Q4 2023.
Ouch. Why such a big drop in that quarter?
It was a mix. Lower sales, obviously, but also that lower gross profit margin we mentioned. Part of the margin issue in Q4 was apparently because they sold more products with lower margins.
A strategic shift, perhaps, or just market conditions?
Hard to say definitively from just this, but it contributed. Also remember, Q4 2023 had a helpful one-off. A write-back of a provision for old stock. That benefit didn't repeat in Q4 2024.
Got it. Any positives on the cost side in Q4?
Actually, yes. Administrative expenses were lower in Q4 2024. They reversed a provision for doubtful debts and had a write-back related to computer systems. But even with that, the higher interest expense still dragged down the overall Q4 profit.
And how did Q4 look compared to the quarter just before it, Q3 2024, the one we analyzed last time?
Compared to Q3, the Q4 revenue was down almost 12%, which again fits that seasonal pattern we talked about. PBT also decreased sequentially, down about 12% from Q3. The main reasons cited were those higher interest costs in Q4, and also Q3 had benefited from a gain on selling some financial assets, which wasn't there in Q4.
Right, so stripping out that one-off gain makes the Q4 drop seem maybe less severe sequentially, but still down.
Precisely. The underlying trend was still softer.
Okay, so the big picture is declining revenue, significant profit pressure. But Harrison's isn't just one thing, is it? They have different business segments. How did those fare across the whole of 2024?
Yeah, this breakdown is always interesting. Their main engine, trading and distribution, that's over 97% of revenue, saw its overall revenue fall by 3.73%.
And that's where the FMCG weakness sits.
Exactly. FMCG sales within that segment dropped by almost 6%. But interestingly, it wasn't all negative in trading and distribution.
Uh,
Building materials actually grew by about 3.5%, and industrial and agriculture chemicals had a really strong year, up over 16%.
16%. That's quite a jump for chemicals. Any reason given for the building materials increase?
Yes. The report suggests it might have been dealers stocking up on cement because they expected prices to go up. So perhaps a bit of a temporary boost driven by anticipation.
Ah, okay. So maybe not sustained underlying demand growth there. And the overall profit for that big segment.
Despite those bright spots, the profit before interest and tax, or PBIT, for the trading and distribution segment overall was down significantly by over 29%.
So the FMCG drag really pulled it down. What about their other segments, like retailing, Famous Amos?
Right, the retailing segment, which includes Famous Amos in Singapore, its revenue decreased by about 6.6%. They said this was mainly because they stopped representing the Komanoya brand.
Okay, termination of an agency agreement. And profit.
Profitability there also took a hit. Lower gross margins, apparently the cost of cookie batter went up, and higher salary costs in Singapore due to new minimum wage rules.
So, Famous Amos facing cost pressures from both ingredients and labor. Tough times even for cookies.
Seems so.
Were there any segments that actually performed well overall?
Yes, one. The shipping and others segment. It's smaller, but its revenue increased by over 10%.
Driven by?
Higher shipping commissions, particularly in Sabah, it seems. And even better, its PBIT grew by over 11%, partly helped by writing back some sundry revenue from prior years.
So shipping was the unexpected bright spot in 2024.
You could say that. It showed some decent resilience.
Okay, let's shift gears slightly to their balance sheet. How did their overall financial position look at the end of December 2024?
Pretty stable, actually. Total assets increased slightly, and total liabilities also increased slightly.
Any significant changes in debt?
They did increase their short-term borrowings. The report mentions using bankers' acceptances more, which are often used for trade financing, so likely funding working capital needs.
And the equity base?
Equity attributable to the owners also saw a small increase. So no major red flags on the balance sheet structure itself, it seems.
What about cash flow for the full year? Where did the cash come from and where did it go?
They generated positive cash from their core operations, net cash from operating activities. That's generally what you want to see. Good. However, they had a net cash outflow from investing activities. This included buying property, plant, and equipment, and also purchasing some financial assets.
Investing for the future, potentially, and financing.
Financing activities also saw a net cash outflow. This was mainly paying dividends to shareholders and repaying some of their borrowings.
Speaking of dividends, HHMB usually prioritizes them, don't they? How did that look in 2024, given the lower profits?
They absolutely did continue the dividends. The total cash paid out in dividends in 2024 was RM 35.172 million, which is, interestingly, almost exactly the same as in 2023.
Wow, so they maintain the payout despite the profit drop.
Yes, if you calculate the payout ratio based on the profit attributable to owners, it comes out quite high, around 79.5% for 2024.
That shows a strong commitment to shareholders, I suppose.
It certainly suggests that. It's worth noting, though, that no specific dividend was declared or paid in Q4 itself. This reflects the timing of their usual dividend declarations.
Okay, so a challenging year, profits down, but dividends maintained. What's their outlook for 2025? Are they expecting things to turn around?
They're taking a cautiously optimistic view. They expect their overall business to grow, kind of in line with Malaysia's broader economy, which is forecast to grow around 4.5% to 5.5% in 2025.
But they must still see those challenges lingering.
Oh, absolutely. They explicitly mention the ongoing headwinds for FMCG, that subdued consumer sentiment, the persistent issue of parallel imports, and the increased competition in East Malaysia.
So no easy fixes there.
Doesn't sound like it. Management says they plan to work closely with their main suppliers, their principals, to navigate these issues. They do state their belief in long-term growth remains intact, barring major unforeseen shocks.
Are they making any big moves to support that growth?
Yes, and this is quite significant. They started construction on a major new warehouse and logistics facility in Kota Kinabalu, Sabah.
Ah, back to East Malaysia.
Exactly. It's a nearly RM 28 million investment. Construction began in February 2025, and they expect it to be finished by April 2026. This clearly shows a focus on strengthening their infrastructure and position in that key market.
That's a tangible sign of future focus. Given all these challenges, though, particularly the competition,
Yeah.
how would you rate HHMB's economic moat right now? How protected are they?
That's a tough one. Based on this recent performance and the pressures they're describing, I'd have to say their economic moat looks relatively weak at the moment, maybe a 4 out of 10.
Why so low? They have established networks, right?
They do, but the evidence suggests those aren't providing enough insulation. The competition, especially parallel imports and new entrants, is clearly eating into their sales and, crucially, their profitability and margins, particularly in the core FMCG segment and in that vital East Malaysian market. The existing defenses aren't proving strong enough right now.
So if we were to just quickly recap the key risks and challenges heading into the rest of 2025.
It's really a continuation of the 2024 themes, isn't it? You've got the overall consumer spending environment remaining soft. You have the direct competitive threats from parallel imports and new players in East Malaysia hitting their main business.
And internal financial pressures.
Yes, keeping an eye on that gross profit margin is crucial. Managing administrative expenses, especially potential bad debts, and, of course, the impact of those higher interest rates on their borrowing costs. Plus, the general background noise of inflation in the Malaysian FMCG market doesn't help either.
Right. Okay, so let's try and tie this all together. Harrison's holdings clearly faced a tough 2024. Profitability took a significant knock, especially in that core FMCG area.
Driven largely by fierce competition and cautious consumers.
But it wasn't all bad news. The shipping segment showed some positive growth.
A small bright spot, yes.
And importantly, they're making strategic bets for the future, like that big warehouse investment in Sabah, while still making sure to return cash to shareholders through dividends.
That sums it up pretty well.
Yeah.
Which leads us to perhaps the final thought for you, our listener.
Go on.
Given these ongoing headwinds and these forward-looking investments, what are the key things you should be watching? What metrics or developments will really tell the story of whether HHMB can navigate this rough patch and actually hit those long-term growth targets they're aiming for?
That's a great question to leave people with. Maybe things like tracking Malaysian consumer confidence figures, seeing if spending picks up.
Definitely. Or maybe looking for signs of success in how they work with their main FMCG suppliers to counter competition.
And that Sabah warehouse, its progress, and then its actual impact once it's up and running, that will be critical, won't it?
Absolutely. And fundamentally, can they stabilize or even improve those profit margins in what sounds like a very tough competitive environment?
Yeah.
That'll be key.
So, lots to keep an eye on. We definitely encourage you to continue looking into HHMB's reports yourself and keep abreast of the wider Malaysian economic picture.
For sure. Staying informed and doing your own thinking is always the best strategy.